It is my pleasure to welcome you to the session. And today, I think we're talking about something that's incredibly pertinent in our market, and that is access isn't enough, and how payments can empower financial wellness. In saying that, I'd like to welcome up our panelists. We have Mike Olson and David Leibowitz. And guiding our discussion today, our moderator, Richard Ketley. This is going to be a very interesting discussion, so let's get started.
Great, thank you very much. Welcome everyone. Good to see you here. Good to see that there's some people in this conference who are interested in why payments matter as opposed to how we move money from one place to another, which is what I guess most people are thinking about. The topic for today's session is Beyond Access, that true financial inclusion means empowerment. And in this session, we explore how modern payment systems can drive holistic financial wellness, enabling better saving, budgeting, credit access, and financial literacy. As I said, people at this conference are mainly concerned with the mechanics of payments, but we sometimes lose sight of how important payments are in people's lives, and ultimately how they manage their own financial profile, how they engage with financial institutions, and ultimately how they maintain their balance sheet for life. So in South Africa, we have a very high level of financial inclusion, by which I mean that most people now have access to a bank account linked to a card, and are able, even if they don't necessarily do so, to make digital payments of any type. EFTs, instant payments, card payments, you name it. And this is a great achievement. When we started these conferences about 10 years ago, this was not the case. And so we've now moved from a discussion of what's going to be the future of cash to what we heard in the previous session about the Australians saying, well, we now need to regulate to maintain cash because digital payments have become so pervasive in some economies. So we really have achieved a great amount with the initiatives that have been driven. I think this is a bit close to my mouth. The initiatives that have been driven around financial inclusion. But we now need to pivot our focus to around what does this mean? What does being financially included mean to people? And how can we make sure that financial inclusion results in that goal of financial wellness, of having people being able to engage with the financial products that are available to improve their lives and improve the way they manage their risks and profile. So I'm Richard Ketley. I lead the financial services strategy team at Genesis. I've been consulting in the payment space for the last 25 years. And it's really exciting to me that we're at this point that we are today to talk about something other than how do we get an account into people's hands. Our panelists, we have two very distinguished panelists. Mike comes from a very long career in banking, and there's probably not a role related to payments and credit that Mike hasn't fulfilled in one of his roles, and we'll come to that in more detail. David Leibowitz is at Discovery Bank, and as we, I think, all know, Discovery has really led the world in terms of the application of behavioral economics and trying to use data and information to change people's behavior to better outcomes, initially in the health space and now in the space of financial services. So a little more about Mike. Mike spent most of his career at Standard Bank and has held many roles, particularly in credit, from origination through to collections. In his long career, he has seen and driven many of the changes that have created the digital payment ecosystem we engage with today, from moving paper and paper-based processes out of branches to the eventual replacement of those processes with fully digital processes. He was also involved in the early development of credit scoring and the building of data repositories for Standard Bank. Mike has run both the card credit and collections department at Standard Bank. More recently, Mike was the head of credit at African Bank, head of credit for Lerines Group, and the head of Africa Bank Card. Mike returned for his last gig at Standard Bank, running card issuing for the rest of Africa. And currently, Mike is an entrepreneur, building integrated solutions that he will tell you a little more about when we get to it. David is head of technical marketing, not tactical marketing, I was told, at Discovery Bank. I don't think any other bank I've come across has a head of technical marketing, so well done, Dave. Where he leads market analysis, product positioning, and the bank's retail distribution strategy. His thought leadership spans research on the Vitality Money program and the actual spend trend, and the annual spend trend series with Visa, using transactional data to illuminate South Africa's retail and payment dynamics. Previously, as a management consultant at Monitor Deloitte, David delivered innovative projects across financial services, media, and telecommunications. His expertise spans product development, market insight, behavioral economics, and reward programs. He holds a degree in electrical and information engineering from the University of Witwatersrand. Okay, we've got the embarrassing part out of the way. So before we get into the discussion, I'd like to give each of our participants a few moments to just tell us their perspective on financial wellness, why they're on the stage to talk about financial wellness and what it means to them in terms of the way they've interacted, not just with their organizations, but with the people who use the products and services that their organizations deliver. So over to you, Mike.
I'll start on a lighter note, if I may. You know, you come here and you've retired and you think you get away from a previous line manager, and then he's sitting right here giving you the eyeball. Yeah? If I may, I just want to take a step back about 45 years and it's important for context because of how it was back then. So if you banked or you went to your family bank, right, and that's where you would bank, you would get your loans, your vehicle finance, whatever. One relationship. Your employer would give you your pension fund, your group life, and your medical. So your financial life was actually in two places, and you were almost absorbed into it. Okay. Fast forward 45 years, none of that exists anymore. There's an opportunity in that, and there's a threat in that, and we heard some of it this morning in terms of the savings levels are not where they can be, the literacy levels are perhaps not what they could be, etc., etc. And it's my view is it's part and parcel of what's not there anymore, but now we've got the opportunity to actually drive some of that. So when I think about financial wellness, though, I don't think about financial wellness in isolation. So this is my other building block. Firstly, I think about home wellness, because you've got to be happy at home. At the end of the day, we've all just got to be happy, right? So you've got to be happy at home. Then you've got to be happy at work. Yes, Lincoln, I had to be happy at work. But you have to be happy at work, right? Then your finances can be well, and lastly, you can be mentally well and really well. Now that for me is pretty precious, and I'm going to be today focusing more on the customer dimension, because it's very personal for me. I've lost a brother to mental illness. I lost a good buddy a few months ago to mental illness. The one was work stress or work unwellness, and the other one the more recent one was financial unwellness, let's put it that way. So what we're trying to do now is build an ecosystem where, actually with a couple of the things that were said this morning, we're trying to build a relationship model through an ecosystem with customers to take them on a journey. But you have to start with debt, because debt's the pressure point. You can't think about savings and investments until you've dealt with debt. So, and then if you think about all the things we've got, we're rich in data, we can use AI, call centers, etc., etc. You and I, with respect, are not my target market. Why? Because we've got financial advisors, relationship bankers. It's the people that aren't in this room that need more help. Some people here might need a bit of debt help, but for the let's call it the average South African or the next sort of class, whatever you want to call it, that's where I think there's a huge opportunity and an obligation. Opportunity to improve their lives, opportunity to drive the economy, and I think as a society and as industry, we've got a duty to do that.
Thank you, Mike.
So, with financial access and financial health, your financial access gets you in, financial health gets you through. And what I mean by that is, with financial access, it's having access to the bank accounts, it's having access to all the payment rails. Thank you for building a lot of those, by the way. But it's necessary. It's not sufficient to simply be able to move money. Financial health, on the other hand, is linked to risk. It's inherently behavioral. And it's something that is in people's control if they're able to get the tools to measure it. Now, when I talk about risks, Mike and Richard have touched on them, but the main ones I'm going to focus on is unaffordable debt, unexpected loss of income, unforeseen expenses, and later on in life, something that gets overlooked, retirement shortfall, being financially independent when you are retired. Now, when we survey South Africans and we ask them about how they feel they're doing here, generally we're an optimistic group overall. Depends on the day and the topic and if you wake up with water and electricity that morning. But in general, we're pretty optimistic. And we see that come through when people are surveyed about their financial health. They think that they're doing better than they are. They overstate their performance, but underrate the likelihood of shocks happening to them and how those shocks could impact them. When in reality, we look at the data, and as Mike said, people aren't saving enough. We don't have emergency savings. We don't have retirement savings, and we're not saving enough. We don't have sufficient retirement cover if we have insurance cover. If we have insurance cover at all, that's life insurance, medical insurance, short-term insurance. And we're borrowing far more than we should, particularly when you consider our formal employment rate against the rate of borrowing. So, as Mike said, there was a role back in the day that your employer drove with driving a lot of this behavioral health. But today, as he said, you're all over the place with different institutions. So you need someone now, and I believe that role sits with the banks, to help measure financial health, help manage financial health. And depending on the model you want to apply as a financial institution, you can offer short-term rewards and incentives to drive financial health. That's what we're doing at Discovery. But critical to that, to measure financial health and to help manage it, is access to data. It's interesting that both gentlemen with me have mentioned the prevalence of cash in South Africa or in other countries where they're trying to still regulate that cash remains in the economy to an extent. Here, as Richard said, we're financially included, but bank accounts are just a pass-through mechanism for a lot of the population. Money flows in, they go to an ATM and they cash out and draw everything out in one go. And when they transact in a cash-based economy, financial providers can't draw insights on the payments that the clients are making. That's not just for the benefit of the financial provider. If we can't measure your financial health as clients, we can't share it back with you. We can't give you the tools to drive it. So Richard mentioned that something Discovery focuses on is behavior change. And we've been very successful in doing that with driving physical health. So I'm going to just highlight some of the parallels that we can take from the learnings there and apply it to financial health as well. If you take a gym, the gym membership is the access. That's the bank account. We've got high inclusion already. But getting physically fit involves following repeat, consistent behaviors that drive physical health, that you get fitter, that you get stronger. You have to exercise, you have to show up to classes. And when that happens, the result is you live longer, your immune system is stronger, so you don't get sick as often, and when you do, you bounce back quicker. And the exact same principles can be applied with financial health. For individuals that follow healthy financial behaviors to mitigate against the risks I mentioned, those individuals are better able to afford debt, they're better able to handle unforeseen events that are thrown at them without derailing their monthly budget, and they're better able to keep their retirement and saving goals on track as they move through life, no matter what's thrown at them. So I think the key thing I want to wrap up on then on what financial health is to make a point that to an extent it's income agnostic. There is a correlation between how much you earn and your financial health, of course, but generally when it comes to these risks, whether you're low income, middle income, or high income, the reality is that it's not so much about how much you earn, it's about the behaviors you follow with what you earn.
Thanks, great. That's a very nice framing. Mike, can I come back to you? Could you, so I think David's theme is going to be around data. So Mike, can your theme be about how the payment instruments we use impact on our financial health, and what do we need to do to empower consumers to be healthy, both in terms of how they spend, but how they pay, given that this is a payments conference?
Again, I'll go back many years. So in those days, we had a thing called checks, and we had a thing called stop orders, and we had cash. Checks were push payments. Stop orders were push payments. So the customer controlled who got paid and who didn't get paid. Today, there's very different push and pulls, but who actually decides what gets paid and not paid? It's largely up to whichever institution is driving the most efficient and especially effective strike date alignment, etc., payment collections. There's not necessarily a good customer view on that because of the product fragmentation. You know, these modern words of platforms and modular producers, those are not very relationship friendly and they're not very customer focused, if you know what I mean. It's up to the customer to then manage who he gives debit check or payroll or whatever the case may be. So, you know, somewhere along the line there's got to be a balance, and it may be that from a financial wellness point of view, a particular institution is very good at collecting their particular instrument, but it may be to the detriment of the overall family, and eventually nobody gets paid because of the kind of domino effect. So we've got to be a bit careful. The one thing, I was part of the National Credit Act project at Standard back then, and the debt counselling side of it. The good thing about that was that it's one debit and it neutralizes at least the credit providers that are participating, and everybody gets the same. So if you compare that in stark contrast to what we're talking about now, where if that doesn't apply, it becomes a problem. And then, of course, when you haven't got the financial literacy to understand the impact of paying this and not paying that, you know. I'll give you an example of sometimes the games that got played in South Africa, and no names, no pactoral. But a particular bank, they said, on the app you can cancel any debit order as long as it's not ours. If you want to cancel ours, you've got to go to a branch. I don't know how I feel about that. You can make up your own mind, but you know, what does that do for the customer? I warned you, I'm coming at it a bit more from a customer wellness perspective. I'm not saying it's right or it's wrong, you know. Some forums you'll have that conversation and say, absolutely, you know, we have to worry about our income statement, etc., etc. The customer must figure that out. They know what they're doing. But I think we've also got an opportunity, and I think there's money in this, to actually guide the customer to structure their financial lives. So you get that balance through the four that I spoke about, with payments in the back. Because there's no doubt in my mind that the right payments management collectively is better for everybody than individually.
And what would you think are some of the steps that banks or financial providers should implement to encourage this kind of awareness that you're looking at in terms of understanding what's going to be hitting my account when and those kind of issues?
I think we've got to look at different relationship models and engagement models. At the moment, we're using a lot of push SMSs, etc., and app notifications, etc., assuming that the customer can, in 140 letters or whatever, understand what you're saying. I do think we've got to think about a relationship layer below where the current relationship is, using way more direct means, but where there can be bi-dimension or both directions, bi-directional engagement. At the moment, the engagement tends to be from the institution to the customer, and then the customer's got to navigate it. I'll give you one example of that. If you're a customer, the average customer in South Africa today has, on the credit bureau, has 7 loans. He gets himself into trouble. Let's say there's 4 credit providers, because there's 2 loans or whatever with one. He's now got to go and negotiate with 4 separate entities who've all got separate requirements, etc., etc. I struggled in my last while in banking to even navigate my own organization, and I was in it. For a customer, that's very difficult to do. So I think the relationship model needs to be brought down, and it can't just be private banking and through the financial consultants. I think there's very different ways of doing it, and that's where I think the opportunity is.
And I assume with the level of digital engagement we have, that's possible to deliver.
Yeah, I'm not for a second saying don't use digital. In fact, I like AI and I like the apps, etc. But it's how do you nurture it as opposed to I'll just push, you know, and hopefully it lands correctly.
So bringing it back to David, as an organization that specializes in behavioral economics and applied behavioral economics, what have you seen that works in terms of improving outcomes as opposed to just informing consumers of their position?
So firstly, we've got to look at, I've mentioned there are a couple of risks that we want to control for, and Mike's made some good, valid points around how you need the client to maintain an agency. You need them to actually perform the behavior change. You can't force it upon them. So first, what you've got to do as an organization is identify what is the behavior you actually want to drive. So what we've done, for example, and it's driven by payments data, either directly or indirectly, is we picked 5 behaviors that we wanted to manage. And they were spending less than you earn, paying off your debt, saving for retirement, paying off your property, and having short-term or having insurance cover in place. And then there's an underlying behavior that runs through all of those. And Mike mentioned financial literacy, and it comes to planning. That in order to succeed, we've got to help clients plan. We can't force a plan upon them, we have to guide them. That starts with the foundation of financial literacy, educating the client so that they understand, how do I use my products, how do I use the payments infrastructure. Once they've got that basic understanding in place, they can then move on to the next step, which is short-term financial management. How do I use budgeting tools? You mentioned my theme would be data. In terms of short-term budgeting tools, you need a budgeting tool provided by your bank that can give you insights into how you spend, that can help you stay on track. But you need to have the financial understanding to be able to do that. Once you're planning you've got your short-term management in place, you can move on to long-term management. Then you can start looking at things like paying down your debt, paying off a property, investing, saving for retirement. But ultimately, I think it comes down to the payments data itself. We need real-time payments data feeding into these systems, not just into Discovery Bank, into all banks, because we use real-time data. It's so powerful. It gives us so many dimensions to nudge and guide clients in their financial health. It tells us when they're spending, how they're spending, how much they're spending, when they're spending. And we can use that to develop spend patterns. And then, rather than just pushing messaging at everybody that is one message for everybody, we can hyper-personalize it. We can take things like AI and machine learning, and we can develop these very comprehensive behavioral fingerprints for every single client that nudges them on the way to financial health based on their unique payment information. But the requirement for that is to have clean, easy access to payment data across the industry.
And in environments, as Mike highlighted, where we now have products from different institutions, this becomes a much more complex challenge than in the old days when people were largely single bank. So what do we do about this? How do we make sure that data flows in a way that benefits the consumer, but across the different products that they have available to them?
Yeah, so look, obviously open banking, open financing, very topical. We're still kind of finding where we're going to land as a country in this regard. But I think 3 of the maybe key requirements for that to succeed. One is you've got to have the plumbing in place. You've got to have open APIs between financial institutions that the data can move freely. Obviously, there's got to be the right governance and controls in place, but that information must be able to flow. Then when that information is flowing, it needs to be clean. We need to establish consistent guidelines around the taxonomy of that data so that merchant categorization is the same across the board. Geolocation data is clean and makes sense. Data must be real time. It needs to be not just posting date days later. It needs to be something that you can pass to a financial institution, they can interpret and nudge the client to do something right now. And then if you've passed all of that information, you need the client to be able to do something with it once you've informed them of something having happened. And the opportunity there is to build on the work already being done on RPP and RTC and to just keep pushing that infrastructural development of real-time payments, low-cost real-time payments, to make it as easy as possible and affordable as possible to move money around responsibly.
Interesting. Mike?
Can I come in on that?
Yes,
one?
please.
So we've looked at, when I was still in corporate, we looked at various apps and exactly why do they go back to the same app? And I coined this, in fact we did, Lincoln. What makes you live in an app, you know? So there's personal data, and think about not necessarily an app, that's a form factor in a way. It could be a CRM system or any front-end engagement. So the point is that there's customer data and they can pull data. So for example, they may say a free credit bureau report once a year. So we provide that. Or they pull it when they need it and there's a small fee or there's no fee, whatever the case may be. And then through the mechanism, let's keep it generic, you can then guide the customer and say, what are you seeing, et cetera, et cetera. And that's a form of creating a relationship. And then you build it out, and you build out this, let's call it a super app or super CRM, where you actually build an engagement model. And then when that customer needs help, can either interface with a bot or whatever the case may be, or, with AI, it doesn't really matter. And so that's thing, because otherwise what you do is you end up with an internal repository, and you say, well, we've got to build it industry-wide. I think that's impractical. It's just not going to happen. Why? Because we're competitive. Okay. Number one. So and then obviously with APIs and especially customer engagement, you can pull as you need, and you can create it for the customer. And then you're not building this super warehouse of data for everybody and everything. What you're doing is the customer becomes his own segment of one, and you become the framework.
Interesting. In the earlier session, our visitor from Australia highlighted how in Australia they haven't really focused on open banking, but on open data. And I think this is what you're talking about, is in a multi-banked or multi-product environment, the ability to take a view on the customer requires all the data to be able to come to one place.
Yep.
And that requires permissions and probably requires regulatory...
Absolutely. But curatorship, permissions, resilience, security, the normal.
Yeah, because we compete as institutions, we're unlikely to be able to get there unaided by the regulator.
Yeah, so I'm more in a bit of the how. I'm not disagreeing with you, I'm just into the how, because it's that relationship layer because the components, there's so many wonderful technologies and components and capabilities out there. It's now to pull it together in a way that's customer centric.
But David, tell me, when I see on my app, which I won't mention which bank it comes from, that I had a Take-A-Lot transaction, how do you make sense of that kind of transaction? Because it's Take-A-Lot. It's not telling you whether I was buying 3 crates of wine or some gym equipment, which I presume you would treat differently in your behavioral framework.
Of course, you'd get rewards on that one.
Yes, I'd get rewards on my 3 crates of wine. So how far can we go with kind of granular data to drive and inform the kind of nudges we provide to customers?
So I think that's one of the challenges we actually have at Discovery, and our work in AI and machine learning has really helped with trying to get to as best an approximate guess as possible what is in that Take-A-Lot cart. But it does get tricky, because you take somebody like Woolworths. A client goes and spends 3,000 Rand at Woolworths. To your point, is it 3,000 Rand on wine? Was it 3,000 Rand on groceries? Was it 3,000 Rand on clothes? Now, when you have something like our financial analyzer tool, we auto-categorize transactions for clients to try and make it easier for them to track a budget. But when we have no idea what is in that basket, we only have the cost, the date, the when, the how much. There we have to now leave it to the client, and we have to just leave it as uncategorized, and we rely on the client then going and classifying it later on. In an ideal world, we'll eventually move somewhere, and I see the same thing potentially maybe coming out of RPP and RTP in the future, is that we'll be able to pass SKU level data or individual basket data in transactions. Now, as Mike said, people are competitive, so they're not necessarily going to want to provide that level of granular information. But we see at Discovery that if you take our partners like Woolworths, Checkers, Clicks, Dis-Chem, in order to drive the specific behaviors we're trying to from a health perspective, a physical health perspective, they do pass us information at a basket level, because we only incentivize on healthy products. But it is a lot of work, and there's a lot of red tape around the sharing of that information, what it can be used for. And of course, it's only been done with us. It's not something that...
It's a bilateral arrangement.
Exactly. So it is a challenge. How we will get about solving it is still underway.
Do we have the same challenges in understanding when people are making payaways on debt products? I mean, are we able to understand by looking at the data what type of loan is underlying the payments? How good is that data, Mike?
No, that's generally very good.
Okay.
The only time you don't see that is if it's off payroll, so because then it's in the payments in the payroll system of the particular employer. But other than that, it's pretty visible. And then, of course, when people start paying cash and cancelling and things like that, The interesting thing about that, though, is that when you start trying to normalize debt ratios, debt to income ratios, or whatever the case may be, the credit providers generally, if you've got a home loan, that's regarded as debt. But if you're paying rent, it's not regarded as debt, which makes it interesting. The same as if you're paying off a vehicle, it's debt, but if you're not. And then they've got these income to installment to income ratios for home loans. They don't have, but then irrespective of what the rent is, if there's rent, etc. So there's a whole bunch. You've almost got to normalize when you think about an income statement. And if I can sort of just take this off into COVID and the impact of COVID a little bit as well. So post-COVID and after I left the bank, I went and worked on some bit of work. It was voluntary. And we spoke to about 20 customers individually who were applying for debt counselling, but then walked away because debt counselling, unfortunately, doesn't have a great name, and there's obviously in an all industries have got a dark side, right? Anyway, and I spoke to myself about 20 customers in an hour. When you think about financial wellness, and everybody was impacted by COVID, in some way, shape, or form. As we know, after COVID, a lot of parents started living in the flat at the back, or they bought a container home and put it up, etc. And all of a sudden, you went from one kind of family income to another kind of family income, in your financial analysis, and for that matter, your financial estate. We looked at things like one person had a lease-to-own vehicle agreement, which is outside of the National Credit Act completely. That should be criminalised because I got the copy of the agreement. That's just not ethical at all as far as I'm concerned, those kinds of deals. Depends obviously on the wording and so on. So COVID, family structures, etc., when you get into that, you've almost got to personalise it because everybody's a little bit different. And I'm not saying you shouldn't develop averages and norms because I think you should, but be very careful that you don't hang your hat too much on averages, norms, etc.
So, interestingly, there, COVID was around the time we launched as Discovery Bank. And it was very interesting how we could see the changes in people's behavior as we entered the pandemic and as we came out of the pandemic. And we saw those insights from the payments data. And that's because the payments data gave us three very interesting types of signals. We could see stability signals, stress signals, and opportunity signals. And it was interesting going into the pandemic, we saw those stress signals going up. We could see people were increasingly relying on credits. They were increasingly drawing down on savings. Their basket composition was changing. As we started coming out of COVID, the stability signal started increasing again. And the stability signals there were income cadence picked up again. People were getting paid consistently, same type of month, same amount. Their discretionary spend stabilized, their debit order stopped bouncing. Now, Mike's mentioned this relationship layer. Something we're busy building at Discovery Bank, we've already launched it, is Discovery AI. And it's meant to be a coaching mechanism that takes all of these insights we get from payments data and all the other data we have available to pick up on these stress signals as they're starting to occur. And that's why the real-time data is so important. Mike's mentioned that people were going into debt counseling, debt review. The aim of this is to start intervening before that happens. If we can start seeing problems in the payments data, we're not waiting until month end or a month later when we get a report from the credit bureau. We're not waiting until we get a report from Lightstone a month later or 2 months later the client's lost their home. Instead, we're measuring that real-time data to intervene as fast as we can. And we will, in future, be providing financial guidance where possible to start directing the clients to take out additional cover where necessary to cover risks where possible.
Shall I share one or two other insights from those customer engagements in the context of financial wellness? So there was one customer who had been retrenched as a result of COVID, was a teacher. And he had two properties. He has an investment property in Germiston, a flat, and then he had his home. And he was bond-free on the investment property, and then he had the home, and there was value there. And he could have settled all his short-term debt, and obviously there's tax efficiencies as well, by just leveraging a property. And he would have paid off a whole bunch of other things. Cash flow-wise, he would have been materially different. And you would have thought, him and his wife were teachers, that they would have had the financial savvy to just figure that out. I didn't even have to help him further. I just said, well, why don't you do this? And here's the tax advantage, and. Done. It's actually amazing. There was another guy in Midrand, and you've got to get into the personal side of it in a way. He'd got divorced, and he just couldn't get out of a short-term loan. It was a 3-month loan. It was taking about 3,000 rand a month. But he just couldn't find, he couldn't go to the credit provider, the big credit providers, because he didn't have a good enough credit record, and he was with a microlender, and the microlender wasn't prepared to extend term to help him, to go from 3 months to 12 months, or whatever the case may be. Can't remember the specifics. Now, that guy had been paying that loan religiously for, I think it was about 2 years, but he just couldn't get out of the debt trap because his income wasn't going up enough, and he now had this obligation to maintain his child and his ex-wife and so on. And all he needed was a bit of relief, and he had stability in his work, had stability in his income. He'd shown that he's prepared to pay, and. Those are easy solutions. Sometimes it's a bit of guidance to the customer. Sometimes it's a little bit of financial engineering. And of course, in extreme cases, there could still be all the way to debt counseling or sequestration, but each case on its merits.
Great. I think we've got not much time left, about 5 minutes. So any questions? No one submitted any as far as I can see, but we do have a roving mic, and so look forward to some questions from the floor. Yes. Please shout your name. I can't really see you. Both of them.
Both of us.
Thank you. Can you hear me? Yeah, just a question. Listening to the health side and the financial side, from an interoperability perspective, what I was thinking is that in the health world, it seems that you do have that interoperability. Doesn't matter what gym I go to, if I've got a Garmin device or an Apple device, at the end of the day, you can put together a pretty accurate picture of what I'm doing, and even bar the incentives. But from a financial perspective, and I think Mike touched on it, to give somebody the right nudges or to give a good personal financial management, kind of situation, you need not 99% of the situation, you need 100%. If you miss one loan or if you miss one insurance, you need to be perfect. But you won't get that until we've got the full open banking / open data, standardized the participation established to build that 100% data set. So how are you looking at how we bridge that, in the current state until we can really exchange that data?
100%. So what we do at the moment is we have to rely on bureaus. Or alternatively self-reported information. So for things like debt, there we get that straight from the credit bureaus. Things like your insurance products, we get that from Astute. Things like your property information, multiple properties that you might own, we pull that from Lightstone. Within the Discovery group of companies, we leverage as much information as we can that you might have life cover with Discovery Life, and we'll automatically pick that up. So we use all of the available resources that we can. The limitation in that and in the self-reporting is it's effectively using end-of-month balances. We don't know in real time what's going on, and particularly when it's self-reported, we then do have to go and vet all of the information that's provided to us. So it is a current shortcoming of the system, but exactly to the point you had, until there is that interoperability at a industry level, that's the best that we've got. The alternative there is just to try and approximate as much as we can from the data that we do have. So what we do is we create behavioral fingerprints. And the way we do that is we take all of the available data that we do have, those snapshot data points, and we apply we determine the norms for each data point. We then do scenario modeling for every single client to understand at what point is something now bad, at what point is something now good. Then we've got this massive data set where we can do similarity analysis between different types of clients. And although we may not have a view of what's happening to you right now, we can do some predictive modeling based on what we know about you, what we know about others like you, and try to predict what might happen. But there are limitations to that. So for now, it's working with the best we have available.
And I think that answer highlights the importance of something like open data, because obviously if you have the kind of ecosystem that Discovery has created, it does give you a good position a better position to do this than perhaps other players might have. Any other questions? Yes. And please keep your question brief. We're short on time.
Not a problem. Thank you very much. I've really enjoyed this session, and thanks for sharing some very disturbing stats around an average South African having 7 loans. I think the question for me is more directed at Discovery with your complex ecosystems that you've built that are really great. To what extent are you guys looking at the 900 billion of informal economy where there is no information? Just imagine if you had the same kind of partnership you have with the Woolworths, with a spaza shop. Are you guys working with those fintechs that have cracked that economy to start creating that? Otherwise, how are you going to teach that average South African how to spend, how to save if you don't have their data? Thanks.
Excellent question.
Yeah. Yeah, so firstly, I think one of the advantages of being a digital bank is that any South African with a smartphone is able to join. So we've already removed the barrier to joining being physical and kind of having to have proximity to a physical branch. Then the benefit of our account is that all of our accounts come with our Vitality Money program, which measures financial health. Now, if any of these individuals join the program and there isn't data available, as you said, if we don't, from an open banking perspective, we can't pull it from anywhere else or it doesn't exist because they're not anywhere else, they are able to self-report. So all of the behaviors that we measure, it is, unfortunately, then the onus is on the client to have to input the information. But once they input it, our program works across income levels, all the way from low income up to high net worth. So as long as they're able to provide us with the information, the tools and the insights that we're able to generate can still be provided, but we do still have to find a way, to your point, of generating that data for them to automate the process.
Thank you very much, David. I think that's where we're going to have to draw it to a close. 4 takeaways from my side. There's definitely work to be done by the industry in terms of the quality of payments data and the depth of payments data. I'd love to see some kind of way of sharing basket information. There's work to be done in terms of how we understand and provide relationship support to people across income levels. There's still lots of work. I think we're all aware of the shortcomings in the credit space. And then there's stuff for the regulators around this open data framework. So I think 4 topics for 4 future conferences. But thank you very much to our panelists. Great insights. And thank you all for your participation and presence. Thank you.